Good morning, traders. Today is June 12th, excuse me. Very important week and few weeks coming up. We've got Fed, we've got CPI last week that really shook the markets. My main trending systems are still bullish for the US markets. You can see we've had this massive correction in the blue US custom stock market index. And this is the US stock market index. This is the global market index. Global markets are already way down here to 2018-19 levels. They've wiped out quite a bit of excess. We may see another move lower in the US stock market, and that's the point of this special video. We're transitioning. Money is transitioning away from we're going to buy the dip, look for a bigger recovery here, to what is the Fed going to do? What is the Fed going to do to combat inflation, and how are consumers really going to react to this? Overall, global valuations are still quite high. We haven't seen a whole lot of a depreciation in global values, but my expectations are that the US markets are going to revert back down to these levels, where the global markets stay down in these levels, kind of near this green area, and which is where I really think the bottom is going to start to try to set up, which is right in this upper COVID area. Could still get lower, could move down here, but we need to be extremely cautious right now. Don't get married to any long positions, and don't get married into any energy positions. I think energy has reached its peak. Now let's take a look here at gold. This is the gold depreciation cycle phase. Every one of these blue cycle phases is a depreciation, 9.5-year depreciation cycle. It is incredible how gold has held up over the last 2 or 3 years in the midst of COVID, in the midst of everything, and a massive depreciation cycle. You can see it's almost kind of like we had right here in 2000 through 2004, where gold rallied up from about 260, 270, all the way up to about 440, 450, and then stalled. We've moved into that kind of an area here where it's stalled, just like right here. Now, we're about 1.5 years into it, and I think we're going to see a big explosive move up into this 31, 3200 area, and then it's going to do this, which is another 100% move. So from this level to this level is about 600, 700, and from this level to this level is about 800 to 1,000. So I think we're going to go up to 3,200, and then I think we're going to go up to 6,500 or more and really explode higher in the 2026, 27, 28 range. Now, next special update, we are going to talk about the Fed. I've done some modeling, and I'll show you what's going on here in a minute, but somebody brought up some comments about what the Fed did in the 70s, and I want you to understand that this was the end of the gold standard right over in here. And we had an expansion of credit. You can see the red line is M2. M2 is over here on the left, and Fed funds rate, effective funds rate, is right here to the right. You can see that this was a matter of we had an expanding economy. It was very early stage credit creation. Yes, we had debt, but compared to GDP, it was rather minor. The last time we were above 100% debt to GDP ratio was in 1940, I believe 41, 42, 43, and then we had this massive expansion of credit. Now we're at more than 100% debt to GDP ratio, and you can see we've really ramped up our capital creation. The globe has done this, which this is fuel. Think of this as living, breathing capital that has to go somewhere in order to sustain itself and try to find the best opportunities in the global markets. Whereas the Fed has continued to decrease interest rates to create this growth in the economy. This becomes fuel. Somewhere down the road, this is going to turn into a very healthy environment. It's like we've seeded 90% of the planet with capital, and the Fed is trying to move into a normalized rate. Normalized rate for the Fed right now is about 1 to 1.25%. Anything beyond that is going to potentially create some sort of a global contagion. So understand that the Fed would be very wise right now to move maybe 1/4%, maybe 0.5%, and then indicate that they're going to pause and let the global markets unwind a bit. They could move to like 1.25%, 1.5%, and be up near that upper threshold to try to stop inflation. But if they move into the 1.75 or 2 or 2.25, rate, it's going to be ugly. It's going to become even more ugly. So be aware of that. Now, my modeling, very simple modeling, done in Excel here. See if I can expand this out. And of course, Excel is going to give me a little trouble. Okay, good enough. So I'm going to come back over here. So I modeled basically 1974 peak, 82 peak, 2005 peak. Looks like I have that in here twice. Yeah, I do. I'll get rid of this. And make sure I copy this over. Okay, let me refresh. Okay, these numbers, I don't know why they're not there. Let's see if I can do this again. Accessibility. So this is, there we go. Okay, so what happens here, this is a measurement of how much the Fed is actually taking out in red right here, taking out of the economy. And it's a simple measurement. It just measures the lowest Fed funds rate to the highest Fed funds rate, measures how much the Fed raised interest rates, and while we had the rising M2 levels. So the idea here is that the Fed eliminated in 1974 roughly 62% of the US and global economy at this point. They attempted to stall the economy. In 82, they had to be more aggressive because inflation was much stronger. They raised it to 136% of the US and global economy. And that's essentially a measurement of how much the Fed had to raise in order to break inflation. In 2005, Alan Greenspan, which I've mentioned many, many times, was foolish in what he was trying to do. And he actually raised the interest rates enough to eliminate 784.24% of the global economy, wiping out, as we remember, the housing crisis and everything else. It created a huge problem. Now, from the extreme lows of 0.08% Fed funds rate to 2.5 in 2019, the Fed wiped out a whopping 13,460%. Sorry, let me get that right. Yeah, that's 13,460% of the global economy. Had they left rates at 2.5%, they would have essentially contracted the economy by such an amount we would have never possibly returned from that level. Now the Fed funds rate, and let me come over here and show you my modeling system. My modeling suggests, okay, it is not here, it is here. My modeling system suggests that in 2019, the Fed's interest rate should have been somewhere around 1.5 to 1.75. Then by 2019, end of 2019, it could have been up in a 1.75 to 2.0 area. And in 2020, it should have dropped down to about one and a quarter or one. And then by now, we should be at about one and a quarter, roughly one and a half, one and a quarter, which is where I believe the nominal Fed funds rate should be based on my modeling system. Anything beyond that upper pink level gets very, very dangerous. And we really remember in 2019 we were up here at 2.5%. We were very, very high. And remember, this modeling system was created in 2013. So it had already allocated for the housing market crisis, and the recovery, and was really created back over here in 2013, sorry, right over in this area. Understand that we could have been up in this 0.5%, 0.75% without too much difficulty back here in about 2014, 15, instead of staying so low for so long. We could have normalized a lot earlier and gotten out of this mess quite extensively. So the point again is where we're at right now. We've gone from 0.8 to 0.75. We've removed 3,933%. If I do my calculations right, this is 36%. This would be 3,933% of the global economy. We've essentially wiped out the increase in M2 already. Okay, Feds have raised rate by 838%. If they go another 0.5% to 1.25, that's going to wipe out more than almost two times the amount of capital creation we have, and it's going to move us up into the 6,869% wipeout of economic function, or what I call monetary function. The reason this is so important to understand is that in 74, we had to wipe out 62% of our monetary function. In 1982, they became extremely aggressive and wiped out 136%. 2005, Greenspan was overly aggressive, wiped out 784% of monetary function. 2019, the Fed really blew it. They should have moved rates up to about 0.5 or 0.75 and let it settle. And now we're very close to being in some dangerous territory, which is why I think 1.0 is the next move for the Fed. I think that's the smartest way for them to go. That'll be an aggressive monetary devaluation process, and then they can move it down to 0.5 or something, which will still be excessive, but it'll be put us back down into more normalized areas. In reality, folks, 0.25 is still excessive from where we're at, but we need to get up in a normalized function, and we need to let the markets settle. Now, what the markets will do when we settle, pay attention to how these numbers work down here at the bottom. So we're essentially looking at a 27% destruction in asset value and monetary function overall across the globe at 0.25%. If we move to 0.5, we're looking at a 67%. Where we want to be here is right around 1. So 0.75 puts us right around 1. That's exactly where we're at right now. That's essentially where we should stay, in that 0.5 to 0.75 range, to devalue the economy. Going up to, or inflation, going up to 1 or 1.25 puts us up in the point where we're now destructing nearly 2 times the amount of capital we have in the market based on this M2 expansion. And look at how it increases our destruction process here. It becomes very aggressive. So in theory, we should be somewhere around 0.75. It still provides enough of a destructive force for the Fed to step it up a little bit or move it back down as needed, and it essentially balances the economy. So a move above this 0.75 area could be very dangerous. Now, what I wanted to show you was, where's my charts? Where's my charts? Right here. This is the custom volatility index I use to try to show people how the markets are reacting. The markets have lost a lot of bullish momentum, and we're looking at a potential new washout low. You can see down in this area, we get down in a low. This was 2018 low, the December low, and then we start to pull back out of it. This was the December, or the 2019 low, where we had a pullback. This was COVID, extreme low on a global economic collapse. And then we started retesting these lows to pull ourselves back out of it. If we see the markets move down, I expect the markets to move down into this 4 to 6 area, find some immediate support, and then try to move back up into this apex center and begin to move higher. And what I'm going to show you right now is my long-term SPY chart. You can see that I've got a lot of lines on here. This is a weekly chart. We'll go all the way back and I'll try to show you essentially where we're at right now is right in this rotation. Let me spread it out and show you where we're at. So right now we are in this area right here. This is the last few weeks. This was last week with our CPI number coming down. And what I believe we're looking at is an A, B, C, D, E move down to here. And then from there, that's going to put us in an area where we're going to be into this late 2021 near COVID high areas. And this is going to provide us a very solid bounce for a support level to move and start the next phase higher. The Fed will likely move a little higher, deflate things a bit more, and then move lower, hopefully not to zero, hopefully down to 0.5 or 0.25, and let the markets recover again, prompting what I believe is going to be a massive wave 5 rally to the upside. And what I'm going to do is show you this here. This is my chart of the SPY from the 2009 lows, and I count this as 1, 2, 3, 4, 5 up here. And we will likely see this play out exactly as I've drawn or damn close to it, given the research that I've seen. The Fed is not stupid. They do not want to destroy the global economy. They want measured growth. And what we will see is capital. Remember, this chart, where is it? This chart shows us that capital has been growing like mad over the last 20 some years. We've dumped more capital into the markets than we ever imagined. So we were at about $4 trillion, just over $4 trillion in 1999, roughly. We're now at close to 22.5 trillion in M2. That is if I do my math right, that is about a 600% increase in capital that we've created over the last 18 to 25 years. That capital must be put to work. It is actively in the markets, in the banking system, in consumers' hands, and in asset valuation. Yes, it will devalue. Yes, it will revert. Yes, there will be some pain along the way. But ultimately, that capital will continue to search out and seek out investment opportunities as the global markets shift around and capital function transitions over the next 7 years, which is why, from consumer standpoint, we have a massive opportunity here before we reach our wave 5 peak, which will eventually turn into a B, C wave down. Who knows where it's going to go? It may end up going back down to the 2015 levels that I talked about, but we are nowhere close to this, in my opinion. We're going to see some transitioning, and I'll bet you the Fed and the global markets move back into more easy money policy by the end of this year. They just want to break the speculative cycle that's taken place. Now, I will also add that Bitcoin is likely to see quite a bit of pain before we start to see some real growth. So let me see if I can find that in here, and here, and here, and where is it? Here. This was my chart about the bubble burst in Bitcoin. I created this on December 5th, 2021, and I titled it Bubble Burst Bitcoin. The long and short of it is Bitcoin is now back down over here. It is likely to try to come back down to this 10,000 level. I'm not trying to start a fight or whatever with anybody. I just want you to understand that the unraveling of the speculative phase has been on the cards for the past 2.5 years since COVID hit back over here. This was a massive speculative bubble. I use the term beanie babies, but it's very similar to beanie babies. It's just a fad. People jumped in. There was a great rally, just like in beanie babies. Everybody kept saying it was going to go to 100 grand or a million or whatever. And now we're in the unwinding phase. Until the unwinding phase is done, probably back down here between 4,500 and 9,999, the likelihood of any real substantial move in cryptos and Bitcoin is very, very weak. Okay, so now we have huge opportunity in gold and silver. We have this massive opportunity right now in metals, which, remember, capital functions always need safety, security, and a proper, healthy environment. If the globe moves into some sort of contraction, capital, all of that $22.5 trillion, well, not all of it, but a lot of it will move into safety. Safety is likely going to be US stocks, potential foreign markets, miners, metals, and other sectors. We will see how this plays out. I'm expecting it to be a lot like 2012 through 2015 or 16, where we had a unwinding in major markets. We had creation of wealth in foreign markets and emerging markets. I'm expecting the same thing. I'm expecting potentially China and Asia to come out of it next year and start really excelling higher. I'm expecting Europe after the war ends to start excelling a bit higher. And I'm expecting US technology stocks and other stocks, particularly financials and fintech, to do really well over the next 4 or 5 years. But we're not there yet. Right now, you need to keep your money safe in cash, properly hedged. And to give you an example, I teach my clients that this is the hedging that I have my followers follow. We're in 10% stocks, which limits our risk to the downside. We can still have some opportunity, but we're just playing very small amounts, 65% cash, 25% in metals and miners, 10% in bonds. We're looking for a bottom in bonds. They will start to move, but we're not seeing the move upward yet. Alternately, if you don't have the ability to be in metals and bonds, what have you, you can use this alternate portfolio, which is 5% bonds, 10% stocks, 85% cash. Cash is a good safety process right now. Even if it is devaluing in foreign currency, it gives you the ability to jump back in when the timing is right. We're looking for a bottom in bonds, maybe adjusting positions in the next 15 days. We're looking for the markets to try to seek out a bottom, and we're really looking for the markets to finish off this transition. The Fed's going to shock the market, probably with a half a point rate hike, in my opinion, but they would be much smarter to go with a quarter point rate hike and give themselves some leeway in 60 or 90 days for another quarter point rate hike. All right, that's the update for now. Follow me on Twitter and YouTube. This stuff is going to be very important over the next 5 to 7 years. You're going to see huge opportunities setting up. And like I said, if you're not paying attention, you're going to miss some really big moves. Potentially gold and silver skyrocketing 1,000% higher. So here we go.